Welcome everyone to this video, and in this video I'll be talking on the topic how institutions create and visit supply and demand areas. Basically, it's aligned with the topic we just visit treating, which constitute institutional candle then imbalance or fair value gap. So okay, let's go to material. Institutions rarely execute large orders at once because doing so will cause a visible slippage and unfavorable price. I said something like that. Look at what took place at this point. This is almost a one-way direction with no debate. That is why these guys can't always execute order at once. I'll do a breakdown, though I've done that before. Instead, they build position in stages, creating zones of accumulation, demand, or distribution supply, depending on the direction. Demand zone form when institutions buy heavily from a region, driving price sharply upward. Supply zone form when institutions sell in bulk, pushing price downward. After a strong move, price often revisit these areas to complete unfilled institutional orders, offering new traders opportunity for retail traders who understand this footprint. So if you don't understand the footprint, then you are going to be lost. But in this video, I'm going to show you guys how to spot some of these things and know when these guys come into the market to execute that trade. So basically, we can see the structure clearly. Let me use an uptrend in this case. Price higher high, higher low, higher high, higher low, higher high. Then in this side we have the lower low, lower high, lower low. This acts as a consolidation, not really a valid pullback. This is not a valid pullback. But the center idea is that assuming Swiss bank, Switzerland bank is coming to execute an order which can be classified as buying a particular currency, let's say US dollar, 40 million worth of US dollar, right? These guys then correct, let me say another CBN of a particular country, maybe the currency is not doing well, let's assume, so they want to buy a US dollar at amount worth 30 million in order to maybe subsidize the currency to hold a stable exchange rate, right? So this is two financial institutions coming into the market, and then we have you and I, retailers, retail still in play. Let me put retail as a middle because we don't have the power to lead front or back. We are just at the middle trying to, identify when these guys come into the market. So this is what we call order block, right? Please pay attention. What I'm giving in this course is what I took so many years to find out, and at the same time, the amount selling it does not really worth it. So the major thing is making sure people know these things. So now these people cannot, okay, let me say these ones come into the market to sell. Why these ones come into the market to buy, right? Retail traders, we don't have a say. We don't have a direction. We just follow the direction that the market is going. So now they can't allow these guys to sell this quantity or volume of currency at once. Instead, they will split it into a block, or you can call it bulk order. They will split it in block or bulk. What does that mean? It's applicable to these guys. Sorry. So these guys as well cannot execute the order also at once. So they will split it basically into smaller block or bulk order. This one's applicable. So this is our resistance zone, right? This is where institution or demand. Okay, let me say supply, right? This is supply. Demand is on the downside, pushing up. This is a demand zone. So, firstly, they give this guy a chance to execute that order. Let's say what 20 million US dollar in volume. They are coming to sell, right? I don't know how to sketch the chain, right? So let's assume 20 million worth of US dollar executed by switch bank is this movement from the resistance or supply zone to this level, right? Then this particular CBN, let's say the United States Central Bank as well, want to execute the order, but they cannot go at once at the same time. So they will execute 10 million worth of volume first, right? So now these people have $20 million worth still left to sell. These people have $20 million worth of volume to buy. So what happens is that after Swiss franc sell 20, they give United States the chance to buy from the demand zone, and this is the movement, right? Which can be classified as a pullback. Then Swiss franc is given a chance again to execute maybe another 10 million worth, and this is this sell, right? After that, maybe they leave the market and cause a consolidation. Neither this or these people are currently in charge of the market. So there's no institutional present actively at this point. And these people return back to execute their sell order. 10 million or 5 million was left, assuming. And you see this sharp sell that lead to a breakout of this region. Now, how do these people execute these orders in block? That is what I just finished illustrating. So how can we align the market with them? The only way for us to align the market with them is us joining forces at either the demand or the supply zone. In the case of an uptrend, this is order execution by pullback, by broke the recent high, pullback, by broke the recent high, pullback continuously. So retail traders already spot it. That first, this is an uptrend, right? And the price has created swing high and swing lows in the case of an uptrend, which can be classified as higher high, higher high, higher high, higher low, higher low, higher low, right? So what retail traders do is to capitalize on these levels. At this point, you can buy. We can sell at this point. At this point, you can buy. So that's basically supply, institutional supply and demand zone. So all this level here are buy entry. So that means once one section of this execute trade and leave a gap, imbalance in the market, we capitalize on that imbalance, right, to execute our trade. Once the price broke out of this recent high to the recent supply or resistance zone, it has created an imbalance from the breakout region, just in this case, as I illustrated, from the breakout region to the resistance or a supply zone. So what we do as a retail trader, perfect move is to come and wait at this level. As a institution coming to fill another block order, we now capitalize and go into the market with them, basically. So this is how institutional or retail traders can spot and execute trade when institutions come back to revisit a supply and demand zone while executing the block order gradually instead of giving them the chance to execute the order at once, because executing the order at once is not going to favor the financial market, because if these people eject this volume of order into the market at once, it's going to cause a very sharp, in the case of a sell, it's going to cause a very sharp sell candles that may move in a single line straight, instead of situation like this, which give different people opportunity to execute the order in block gradually until they execute all the orders. So that's basically how these guys revisit supply and demand zone. So on that level, retail traders can always capitalize on those revisit supply and demand or resistance support zone, as you may choose to call it. But I'll show you guys the difference between resistance and support, and then demand and supply. This kind of movement within a trade, right, is supply and demand. So you can't call this support and resistance, though Depend on your level of understanding, nothing is wrong. But this is a support level and overall lowest level that the price has reached, and this is resistance. Any zone happening within the trend is no more resistance or support. Instead, it is supply and demand. Or you can classify it as order block. So that is where the terms come from, order block, right? So that takes us to the end of this very topic. It's very short. The material is short, but it's powerful idea, right? See you guys in the next video. Thank you.